Josh, thank you very much for joining us today. How are things in Houston?
They're nice. It's actually finally cool here.
Great time of year to be there, isn't it?
It's great.
So much has happened since the last time we spoke. I can't believe it's been a year, but we're going to talk about all things related to energy. And I always enjoy talking about oil because even though it's one of the largest commodity markets in the world, I'm always surprised by how volatile it could be on any given day. It can move 2, 3, 4%. But let's talk about energy policy now. What does a Trump administration mean for the energy policy and also the oil price going forward?
Yeah, so like you were we were talking about prior to turning on the camera, there's this 333 going on where it's 3 million barrels a day supposedly, although now it's going to be 3 million barrels of oil equivalent a day, targeted of production growth. And that's, I think, sort of the biggest aspect of their policy. They're really trying to get um, a substantial amount of growth to mitigate inflation from a production perspective. And the funny thing is that now that it's gotten watered down to barrels of oil equivalent today, it's actually closer in line to where the policies were going to be and sort of where expected production growth on the natural gas side was going to be. So I think I think we're going to see a really good time for the oil field services companies. And I think the producers, even if they experience slightly lower prices, should benefit a lot from deregulation and then also from build out of LNG exports and petrochemical facilities.
And remind me again, the US is the world's largest oil producer. They produce, is it 13 million barrels a day?
Well, if you include liquids, we're actually close to 21 million barrels a day. I think it's 13.4, 13.3 million barrels a day of crude oil. But if you include various natural gas liquids, and that's where you get to the US being the biggest producer, is sort of in that combination of products.
And do you think it's feasible for the US to increase production by 3 million barrels a day?
I think if you count it as, the US also produces an enormous amount of natural gas. And so, from an oil perspective, that would be growing roughly 15% or so if it was just oil and natural gas liquids. But if you look at it as, let's say, a million barrels a day of natural gas liquids growth, no real oil growth, and then 2 million barrels a day equivalent of natural gas growth, that's really just in line with expectations. And that would just sort of feed existing planned LNG expansions and petrochemical expansions. And then it may not even fully supply the expected growth in data center demand and some of this other sort of growth in energy demand that we're seeing. And then also, here's the part that I think everyone misses when they look at their oil balances for the next few years is if you look at the economic impact of lower taxes and lower regulations, um, there's debates around the fiscal aspect of that, but there should be no debate over the economic impact, which is if you lower taxes and regulations, you increase economic activity. I think almost everyone agrees on that. And so if you have increased economic activity, especially real economic activity with a high multiplier on dollars spent, you should end up seeing a significant increase in energy consumption, including in oil consumption.
I'll tell you, I wish we would have a government that would implement lower taxes in Canada because the taxes here are killing me. I don't mean to digress, but the Trudeau government implemented two new taxes in the past year at the worst possible time. They implemented this carbon tax and also another capital gains tax. And this is one of the big issues in Canada. We're continuously being taxed on after-tax dollars. It's virtually impossible to get ahead here. And now I'm curious, what are you paying for a gallon of gas in Houston?
Uh, 250 approximately US dollars, which is what, 5, 7, something like that, Canadian?
Yeah. So if you so in Toronto, we're probably paying $1.50 to $1.55 a liter, and if you do the conversion on the FX and also into US gallons, you're probably looking at somewhere between 4.50 to $5 a gallon. So just to give you an idea, and a big chunk of that are taxes, both federal taxes and also provincial taxes.
Yeah, that's wild. I was joking about that. In Canadian dollars, it would be about $3.40 Canadian for the 250 or so US here. And actually, it's interesting. I was looking at milk prices. I was chatting with a friend in Canada earlier today, and he was paying, at least where he's at in Eastern Canada, about the same price for a liter of milk as for a liter of gasoline. And again, maybe there's different prices in different spots, and there's some variation here in the US too. And he mentioned that, and actually, it's about 250 a gallon for sort of the low end, just like store brand milk, for whole milk here in Houston as well.
I'll have to check that out because that's an interesting point. So, okay, you talked about lower taxes. Now let's talk about tariffs. And this is another big component of Trump's agenda policy. And he really recently announced that he's going to impose another 10% tariff on China. They already have a 30% tariff on China. But he also said he's going to implement a 25% tariff on both Canada and Mexico. What are your thoughts on this? And what do you think about tariffs overall for the economy?
So when they first announced these tariffs, my thought was that it was a power play. And the idea was, hey, Trump will announce three tariffs, right? This 10% on China, which he might actually plan to implement, but then a 25% tariff on everything from Mexico and Canada makes very little economic sense. So it would be to limit immigration, illegal immigration via the southern border, limit drugs coming in from the southern border, get rid of some of the weird trade stuff where you have stuff made in China, brought to Mexico, one part very slightly changed, and supposedly it's made in Mexico and imported to the US via sort of the new NAFTA sort of agreement. So that was the initial take, and actually it looks like Mexico navigated that effectively, where they capitulated on a number of fronts proactively, and it looks like the U.S., at least Trump's plan on the Mexico side, might actually not be to implement tariffs anymore, still holding that threat out, but Mexico sort of hit his main policy goals right away, it looked like. And again, I could get this wrong. It's possible they end up implementing them anyway, but that's how it looks. Canada, unfortunately, and this is a really low bar because both Canada and Mexico are not particularly well run right now, unfortunately, on a lot of different measures. Canada, unfortunately, missed the low bar set by Mexico and responded negatively to Trump's tariff threat. Trudeau subsequently flew down to meet with Trump and have dinner with him in a event that Trudeau represented as positive, Trump represented as pretty negative, and seemed sort of dissatisfied with the progress. And so I would say if there was, let's say, a 5% chance that we were going to implement tariffs on imports from Canada, including oil, let's say, on that announcement from Trump, because again, anything's possible, very unlikely, but possible. I'd say now, unfortunately, it might be closer to a 10 to 20% chance that tariffs are implemented even on oil, which does not appear to be priced in at all, looking at the equities as well as looking at sort of the forward curve for Western Canadian Select. And so I think it's really unfortunate. We have this wonderful relationship between the US and Canada going back a couple hundred years. You would think that that would be respected by the respective leadership. And again, I think everyone sort of understood, I thought, what Trump was trying to do. And clearly Mexico got the message and just responded, hey, we'll navigate our policy approach to the US differently with a different president. And unfortunately, Canada, it appears, so far has misstepped. Hopefully, the Canadian leadership takes it more seriously. And again, this isn't to try to talk politics at all. Unfortunately, it's just a pure sort of you want to see what people do in order to see what policies are implemented in order to understand where to invest or how to navigate. And so, just purely from that perspective, unfortunately, it seems like Canada is misstepping on this. And that could have really bad consequences for the Canadian economy and also for the US economy if this threat is followed through on.
Well, this is another reason why I find this the oil market so interesting because politics plays a big part of it, right? Because it's produced all over the world. And so what would this mean for Alberta? Because correct me if I'm wrong, but does Alberta export 4 million barrels? Is it 4 million barrels a day to the
Yeah,
US?
That sounds about right, but it might not all be going to the US right now. The TMX pipeline just came on, and so a portion of that oil is going now to the West Coast and getting exported, and then some is getting sent to Sarnia and various other spots in Canada to get refined and used domestically in Canada. So not all of Alberta's production is getting sent down to the U.S., but a lot is, millions of barrels is coming down. And so that would be negative. It would hurt local realized pricing if there was a tariff implemented. There's sort of a necessary amount of oil that needs to get imported from Canada to the Midwest refineries. And so, unfortunately, that probably would mean higher gasoline prices in the Midwest, unless there's some sort of federal US action taken to sort of subsidize, to sort of match the or mitigate the impact of those tariffs, which I could see happen, but that hasn't been promised yet. So there'd be some pain at the pump in the US. Uh, it would probably hurt some of the investment being made right now in Canada to grow heavy oil. And that's actually been a weird disconnect I've seen where if you look at the geopolitical analysts and the oil market analysts, they're starting to similar. I think my assessment of this is sort of consensus at this point. I'm just reading a lot of the different Canadian investment bank perspectives and US investment bank and various policy analysts, and they seem to be sort of at that 20% range plus or minus on tariffs as of right now while we're talking. And the heavy oil producers in Canada seem to almost all have production growth plans for 2025. And it's odd to me that that would be the case, both because they might actually be growing production into a curtailed environment or into a tariffed environment where they end up with a low realized price for that production, but also because there's relatively limited additional export capacity for that oil. So these producers for years got very low prices for their oil because they were overproducing relative to that capacity. And here they have roughly 600,000 barrels a day, maybe a little more, a little less, depending on how you count it and what season and so on. But it seems almost like the spendthrift that finds $100 and just goes and spends it all right away, even if they have credit card debt. It seems like a very poor sort of industry-wide decision to be growing as aggressively as many of these producers are. I know they're excited because they get high oil prices right now for their heavy, but I think it's probably a mistake from an industry perspective to be growing as much as they are, especially into this rising, really unfortunate rising risk of tariffs on their production.
So you touched on pipelines, and in order for Canada to sell its oil to the US, we need pipelines. Trump was a big supporter of the Keystone XL pipeline, but it was terminated on Biden's first day in office in 2021. Do you think Trump can resurrect this pipeline?
I mean, it'd be sort of hard. I think a lot of the right of way has gone away. I was reading about it. I think some of the pipe might have been reused or displaced. So I think he's gonna re-permit it, but I think that may not actually have an impact. And then the reality is with the TMX expansion, as well as some of the other expansions in place, it's not really necessary today. And a portion of that pipeline, the US portion, was already built and used now to transport crude from North Dakota. So it's just not, I'm not sure how much of an impact that really has. And I highly doubt, at least day one, that that leads to any sort of construction projects or sort of reduced bottleneck for Canadian oil.
So let's move the conversation to overseas now, and I want to start with Ukraine. And Biden was Ukraine's biggest ally, but that's all going to end as soon as Trump comes into office. And Trump has said that he's going to end that war within 24 hours. It might be a bit of an exaggeration, but let's just say if he moves toward that target of ending the war, what does that mean to what does that mean to the oil price, if anything?
So I really hope that happens because again, it's just this enormous humanitarian catastrophe, and I think poor leadership by the U.S. as well as various other groups, sort of on all sides of this conflict, have contributed to this massive loss of life and economic destruction. Um, I think even if there is a ceasefire in Ukraine, which again I really hope for, I'm not sure that means that there's going to be a lot more Russian oil brought onto the market. it's not clear that sanctions go away day one. And if you think about what we were just talking about, I think Trump's approach is to err towards sanctions and err towards trade restrictions and then reward progress with relief of that. And so I would expect there to be additional criteria for the reduction or relief of sanctions on, for example, Russia, at least from a US perspective, beyond just a ceasefire in the Ukraine. I think to some extent, there's probably a reasonable case that there's a ceasefire soon. And again, I really hope for that. So I'm biased just from a humanitarian perspective. Um, and then I think it's going to be really interesting in terms of how much energy demand there will be for reconstruction of Ukraine, where given how much money has been donated or allocated or however you want to call it from the US and the EU and various other places to arm Ukraine and enable their continued fight against Russia, you'd hope that there would be money allocated to rebuilding the place that got destroyed. Unfortunately, both Russian occupied Ukraine as well as the portions of the country that have remained independent and sort of under their own sovereignty and control. And so that actually rebuilding is very, very energy intensive and very oil intensive. And so I think you could have a period of time where you have Russian oil. The sanctions on Russia really didn't impact it too much. They were more bullish for oil tankers than they were for because they had to sort of go around and more bullish for like the dark tanker fleet, the fleet that's unofficial and used to evade sanctions rather than the official fleet you'd see through the various tanker stocks that are publicly traded. And so I think you actually could see higher oil prices from the back of a Ukraine truce and ceasefire and hopefully move to peace rather than lower prices for a period of time. And even if you had sanctions drop on Russia, I'm not sure that you see Russia go and rush to flood the oil market. They're in this OPEC plus deal, and OPEC has continued to support the oil market. And I think they've made a lot of progress in terms of much lower global inventories, and they just keep moving towards that, and it keeps being a surprise that they move towards maintaining discipline and maintaining low inventories despite various narratives and various economic developments and so on. So I don't think you would expect Russia to flood the market with oil, even if sanctions were dropped. I think the spot where you could see a big difference would be natural gas. But natural gas, it was even a headline very recently. Natural gas has continued to flow through Ukraine to Western Europe during this war, which again is just so mind-boggling when you think about it. Like, what is war, and how is it possible that these young men and women, in some cases, are dying while they're buying each other's commodities? I mean, it's just such a horrible humanitarian and economic catastrophe and puzzle that that would be happening, but that has been happening. And so that also raises questions about economic impact from the natural gas side. Like, how much more gas would Europe be buying from Russia if sanctions were dropped or, mitigated to some extent, if they're already still buying gas from Russia during all this? So I'm not sure that there's really too much of an impact. And I think people really forget about how energy intensive rebuilding is. And we get reminded every holiday. Thanksgiving was recent, and people talk about how big of an oil demand impact there is from air travel and so on. But holiday weeks tend to actually be lower total oil demand because Thanksgiving in the US, Thursday, a lot of people are off work Friday, so there's way less commuting demand. And the commuting demand is actually, depending on the holiday and time of year and so on, it's actually bigger than the holiday travel demand. And so you can end up with holiday weeks that end up with less demand than normal weeks. And so if you think about that with war, you can look at Russia and Ukraine and their militaries moving around and whatever, but actually you might have more economic activity and more oil consumption and natural gas consumption if you just get back to rebuilding and then to steady state economies. And these are both emerging market, unfortunately, countries at this point where they could see substantial economic growth from their very low current GDP per capita levels.
And as a reminder, the price of oil ripped to $120 a barrel back in Q1 or Q2 of 2022 after Russia invaded Ukraine. And I guess the concern was that Russia's oil was not going to be sold onto the world markets. But even though they placed all these sanctions on Russia, Russia was still able to sell their oil to other countries. Maybe it was China, who knows who they were selling it to. But I guess the point is it didn't really disrupt their production. Like, are they still producing the same amount of oil today as they were back in 2022?
So their production was disrupted for about a month. Um, in April 22, it looks like Russian oil exports were down by 2 or 3 million barrels a day, depending on who you believe. You tend to get better data about 2 years later, but then there were sanctions and there's other sort of reporting issues. But it's sort of one of the stranger things about the oil market that you'll see very different numbers. You'll note I said the US is producing somewhere between like 13.3 and 13.4 million barrels a day. You'd think that there would be a number for that. And the reality is you get that and then it gets revised and it gets revised again. And the reality is it might be close to 13 or 13.5 million barrels a day. And that's the US, where there's taxes paid on a nearly real-time basis, right? Monthly from a lot of these producers on that production. And even those numbers are not always 100% correct. So lots of, I think people are very unforgiving on this, but there's just a reality, which is there has to be this sort of cone of uncertainty when it comes to oil production. So yeah, let's say 2 million barrels a day, Russian production offline, April 2022, and then comes back on. And then the sort of bad joke is that if it was, let's say, $125 a barrel in 2022, what's that work out to be in inflation adjusted dollars? Maybe that's 140 or 150, because there was substantial inflation on the back of that. Even when oil prices came down, you actually still saw global inflation rise. You still saw US and Canadian inflation rise quite a bit subsequent to that April 2022 number. So yeah, I think there's real questions around, hey, what happens when there is a ceasefire, when there is peace, and hopefully it comes soon. But again, I think I'm actually more in the camp of a tilt further in favor of oil prices and demand exceeding supply imbalance than the other way around that particular conflict.
And let's talk about the Middle East now. We still have war going on. What are your thoughts there, and what does this mean to the oil price?
So it's been very odd. So there was this tragic uh, terrorist event and sort of catastrophe a little over a year ago now in Israel, and there have been various fronts on combination of a war and different bombing campaigns and so on in the aftermath of that. And there have been rumored ceasefires or peace deals there almost every month. And then there's even been direct conflict between Israel and Iran, where Iran is an oil producer and actually has grown their production and exports a lot in the last few years. And the news of peace always hurts the oil price, but it doesn't seem to, for most of this, it's conflicts between places that don't produce oil and other places that don't produce oil. And there's just the risk is this sort of secondary effect of spillover. And even where there's been spillover, there's not been any impact on oil exports other than a very minor impact in Yemen, where Israel did bomb Yemen's oil export facilities twice. So that was interesting, but also very, very minor. I think the thing that's sort of missed as the media sort of mostly lines up against Israel and against oil prices is that unfortunately peace has not broken out in the Middle East. And sort of the latest news is that there's this civil war that's reemerged in Syria, which is a small oil producer, but is adjacent to multiple very large and variable oil producers like Iran and Iraq. And it's sort of a nexus of different conflicting forces in the Middle East. Um, and so, without real peace in the Middle East and with this sort of continued conflict, even Israel and Lebanon, where there are still rockets as recently as the last day or so, rockets coming in from Lebanon to Israel and Israel bombing Lebanon, and I think maybe even sending troops up there or still maintaining a troop presence up there. So there's lots of noise in terms of peace and no no reality, unfortunately. And then there's lots of noise around oil supply disruptions and no reality so far. And I think the reality around that whole thing is that this is all just the lead up to Trump coming into office. And again, it's sort of interesting how effective Trump has been in just tweeting stuff or putting it on Truth Social, whatever his like latest social media thing is, and getting enormous global responses to just him like typing away at 2 a.m. And so um, there's a real threat that Iran is going to see sanctions and their oil production disrupted and exports disrupted substantially, even without sort of a military action, just purely from the US enforcing sanctions that have been waived and with lax enforcement in the last few years. So that I think is the biggest thing out of all of it. And again, there's sort of all of this noise. And then the Syria thing could potentially spiral. The Iran-Israel conflict could spiral, but maybe only until Trump comes into office because he's sort of threatened, hey, if that happens, we'll like flatten you to Iran. So that's and I think everyone is so scared of him and he is so erratic. His supporters as well as his detractors will admit this. So no one knows what he'll do, so you don't want to take the risk. And again, this is where I think Canada made such a mistake with the Trump tariff threats. You just have to take it seriously and hope he doesn't mean it rather than the other way around. So anyway, long way of saying I think Iranian oil may come off substantially due to Trump actual Iran tariff and sanction enforcement, and then sorry, sanction, not tariff. And then I think there is a risk from the Syrian civil war turning into more of a regional conflict, which again I hope doesn't happen, but that actually could affect oil. And then the Israel conflict in Gaza as well as Lebanon, very little direct impact as long as Iran continues to mostly stay out of it and Israel continues to not attack Iran's oil export facilities. So long way of saying not a whole lot and just wait until January to see what happens with the US and Iranian oil exports.
And so there's a lot to unpack there, but let's just tackle it one thing at a time. But this is one of the things that kind of confounds me about the oil market because you have this war going on in Ukraine and Russia. Apparently, there's sanctions against Russia, but who knows? And then you have this backdoor deal between the US and Iran, and they're producing or allowed to produce and sell their oil onto the world markets. I think it's 2 million barrels a day. Is that right?
Yeah, I think Iran's production is closer to 3.5 million barrels a day, but they do have substantial domestic consumption. So yeah, I think the exports are roughly 2 million barrels a day.
So you have all this supply coming onto the market, and yet there's also this threat that supply can be disrupted. But yet we have oil that's $70 a barrel, and it's been hanging out there for quite a few months this year. And I'm just surprised it's not significantly higher. And so I want to get your thoughts on this. Do you think it has to do with a slowdown in the global economy, maybe in the US, maybe in China? What are your thoughts?
Yeah, I think we forget how weak the global economy is, and maybe it's easier to forget in Texas where the economy is still somewhat booming, even with a weak oil price, and maybe harder to forget in parts of Canada where there's real, I guess you would say negative real economic growth because of the impact of inflation and very poor economic policies spilling over into a very, very weak economy. So yeah, I mean, China has been extremely disappointing in terms of oil demand. I was looking at their year over year oil demand and for November it looks like it was basically flat, which is horrible for China, which had been growing close to 1 million barrels a day a year for a decade. And so I mean, it's really tragic for the Chinese people, where there's like roughly 1.4 billion Chinese people, and they're using a fraction of how much oil is used in the US and even a fraction of how much Canadians use on a per capita basis. So that tells you just how tough life is there and how few sort of the luxuries and even just, it tells you also about the composition of their diet and how people are really not able to eat how they might choose to. So I don't think that's likely to last. And I think you're seeing it inflect where year over year demand had been high at the start of the year and then fell negative for a few months this year and now is swinging back positive in China. And then similar in Europe, where there's been very weak economic growth and where you're seeing a real political shift, along with seeing an increase in demand in places that were perceived as very weak, like Southern Europe. You saw substantial year-over-year demand growth in Spain and Portugal and Italy, which is thrilling to see. I mean, these were very weak economies. They were considered potential hotspots for another crisis in the shortly after the financial crisis, 2010, 2011. And so it's great to see that sort of demand growth. And hopefully we see this swing politically in Germany and several other places that have been ultra weak. And I think we're actually it's been very weak, but again, sort of across multiple of these jurisdictions, I think we're sort of in this positive trajectory with a positive rate of change for oil demand as well as economic activity. And we're starting to see it. It's fun doing this on the oil side because you actually see that demand and consumption data, and you can see that sort of positive inflection way before it shows up in the news headlines or what have you.
Josh, I want to ask you about M&A now. We've seen some massive deals here in the past year. Exxon paid over $60 billion for Pioneer. Chevron paid over $50 billion for Hess. Why is this going on, and do you think it continues?
Yeah, so um, I think they're buying these assets partly because they're bullish on oil. And if you underwrite the assets, they only really make sense at much higher oil prices relative to the price that's being paid for the assets by Exxon and Chevron and Oxy and some of these other very large companies that purport to have very deep inventories of very low cost production. And so I think they're bullish on oil and bearish on their own inventory, as well as on the inventory held by their competitors. And it's really hard to construct a story for these transactions that can reconcile the prices that are paid, along with the specifics of these assets and the specifics of um, the assets actually held by the companies outside of what they just bought without that specific explanation. So, you say, oh, well, it's this strategic asset that they needed to buy, let's say Exxon buying Pioneer. Well, sort of, except Exxon supposedly had 30 years of inventory breaking even at $40 oil. So how do you reconcile that? Or Chevron buying Hess to get into Guyana? Well, on one hand, yeah, that's a world-class asset. On the other hand, at the price they paid for Hess and the sort of delay in getting to a material production and cash flow level versus the price paid, you really have to wonder, okay, what oil price do you need for that to make sense? And then why aren't they just spending that money if they want to grow on drilling more Permian oil wells or various other places? And so I made this point rhetorically um, in I think another either a podcast or a Twitter space, something like that. And one of my friends challenged me on it. He said, "Hey, no, that can't be true. Chevron says their break even super low. Mike Wirth said this at some conference or whatever." So okay, let's pull open the financials. So we pulled open the financials together and looked at it, and Chevron's break even was $60 for their Permian oil development, which actually should not be that surprising because the Fed they do, I think the Dallas Fed, they do this monthly survey, and they showed a break even of, I think it was 63 or $64. So that shows Chevron better than average in the Permian, which is great for a super major. It's very hard for them to do shale because they're such small projects relative to these giant organizations. So good for them, right? They're better than average, but they're not $40 a barrel. And so again, when you just back into what circumstances make sense for these companies that are famous for good capital allocation, particularly Exxon and Chevron, they're awarded very high valuation multiples in the market, and they've been actively buying back their own stock for years, in addition to paying dividends and doing other sorts of deals. So for them to go and spend that money on these acquisitions, and you look at the underwriting for these deals, I mean, they really only make sense at much higher oil prices. So it looks like they're preparing for it. And I think they don't really want to come out and publicly say, oh, I think oil is going to be 150 or whatever. But I mean, you underwrite the Pioneer acquisition, I mean, you really need a long time horizon. And to meet Exxon's hurdle, which again is phenomenal. I mean, this is Rockefeller's company. Their return on equity for decades and frankly over a century was enormous. So to not completely destroy that, you need a much higher oil price. And again, they say, oh, we don't underwrite to higher oil prices. We're a full cycle oriented company. But if you look at that valuation and you look at Pioneer's assets and you look at their actual, drilling cost and actual completion cost and infrastructure and so on, and fully burden these assets, I mean, you might need $90 oil, $95 oil just to sort of hit let's say 10 or 15% sort of return relative to the purchase price. And then if you consider Exxon's approach, their strategy is truly to be a full cycle oriented company. So if you take into account oil volatility, and like you mentioned, oil volatility is phenomenal. I mean, it's the OVX is at 35, which is actually sort of low for oil, which means expected volatility of 35% a year. So up or down by 35% a year. For context, the stock market, the last I checked, VIX was like 12. So the stock market's expected to move 12% a year based on that volatility measure. I know it's not perfect, but let's just use this as like a heuristic. Oil is expected to move three times the stock market, and that's a low measure for oil. So if you take into account that volatility, it implies that they actually, on a volatility adjusted basis, are underwriting to something like 120, maybe higher. And so again, to me, it just is this very strong signal of an expectation of much higher oil prices, which is consistent with OPEC's behavior. It's consistent with various other large market participants. And frankly, it's even consistent with how China has engaged with the oil market, where they keep coming in after periods where they slow down on purchases and slow down on consumption and just hitting the bid and taking all of the oil that they can get. And we saw imports up enormously. I think it was in October. I think they were down slightly in November just because people figured out that was happening. I wouldn't be surprised to see imports up a lot. It's the very start of December, so we'll see. But I wouldn't be surprised if we don't see oil prices up. Or sorry, oil imports up in China a lot for the month of December.
So I'm going to put you on the spot now. As we discussed, there's a lot going on domestically and there's a lot going on internationally. When we talk this time next year, where's the price of oil going to be?
Um,
WTI.
well, I thought it would be higher last year. Various other folks thought it would be a lot lower. And I think, like you said, we're at about the same price as we were a year ago. Um, I had trouble finding a prominent oil analyst or fund manager or other sort of prognosticator publicly calling for much higher oil prices as I was researching leading up to this interview. So I'll be the guy. I think oil prices go way higher. I think people are massively underestimating supply risk. I think they're massively underestimating this inflection higher in important oil consuming economies around the world. And I think they're underestimating the potential improvements from cutting taxes and deregulating in the US as sort of a leader of that happening in Argentina already. Despite people warning of all sorts of problems, it's having enormous positive effects. And we're seeing the Argentinian economy inflect higher. And I think hopefully that we see that in Canada next year and various other jurisdictions. And so, and I think it'll be interesting to see how quickly jurisdictions like Mexico, the EU, China, India, various other places, they don't like to admit it, but they sort of take their economic lead from the US to some extent. And the US is a big consumer of various products or services that they offer and vice versa. So hopefully we actually see a lot of economic growth. If we see that there is not enough oil supply and not enough oil capacity. And so I think my call on the economy is pretty bullish globally, and my call on oil is much higher than where we're seeing. So over 100. And again, I can't find anyone even calling for like $85 oil or higher for next year. So I'll go higher. And I think if it's going to be higher, it'll be way higher.
And what about nat gas?
Nat gas is uncomfortable for me because I'm actually bullish natural gas for the first time in a long time. And the weather just turned horribly bearish. So let's say I'll be bullish natural gas after this like unseasonably warm spot that's supposed to be coming in the second half of December. So from that, or once that sort of gets priced in, which it doesn't seem to be fully priced into the spot price, from there, I think things look really good. Supply has been pretty disappointing relative to the move over $3 an MCF at NYMEX. And then as you see Waha and as you see ACO, so that's the West Texas local price and the Canadian sort of Alberta local price, as you see them come up, but not see a lot of incremental supply in those jurisdictions as those prices for those local, I mean, Waha was -7 at one point earlier this year, and ACO was down in the pennies. So as we see those prices up, but supply not up a lot in those jurisdictions, I think that's really promising for what we have to come for natural gas for the next year or so. So, I mean, it feels sort of funny to say this, but I think the forward curve price for gas is a little too low. And coming out of a $2 price a couple months ago, I think we could see 350 plus for next year for an average price, which again, it feels uncomfortable because I've been bearish gas for a couple years now, but it looks like now or a couple weeks from now, once we get past this sort of current warmer than usual weather spat, I think is a really good place to be bullish gas for the next year.
Well, Josh, that was a great discussion. I always enjoy talking about oil with you and also policy and politics and the intersection of those three elements. And if somebody would like to follow you online and learn more about your services, where can they go?
Yeah, they can find us at bisoninterests.com, and we have a roughly monthly newsletter, and we share thoughts on the oil and gas markets as well as on the economy and on oil and gas stocks, which is what we're focused on.
Once again, Josh, thank you.
Thank you.